Second. Okay, we are live.
Okay, welcome everyone for who we have here. Today we're going to be talking about stock selection, but not telling you specifically what stocks to buy. Sorry, mom. Um, Basically the whole stock market. No one really has any idea what's right and what's wrong, and there really is no right and wrong. And as Michael Scott said, once we're up, then we can expect us to get hurt again. So here's the agenda today. We're going to do introductions, but we don't have any new people here or many people at all, which is okay. And then Joe just going to do a current event, get into the actual information of the general topic, followed by a discussion and then a preview of next month, who we're going to see, guest speakers, and what we're going to talk about. So we'll skip this here. And Joe, you can start us off with our market update.
So it looks like our last meeting was the second Tuesday last month due to the election, so there hasn't been a long span of time in between then. A few things that have happened since then, though, are the rise of the electronic vehicles. Previously mentioned Tesla applied to be in the S&P 500 or became eligible. Originally they were denied, but that decision has since changed. So they've had a pretty decent run up over the course of the time since our last meeting. We've also seen the rise of the weed stocks due to Democratic legislation being less strict on those regulations. And then also Bitcoin hit an all-time high today as of close. That's a closing all-time high. It didn't hit the intraday all-time high, but so people continue to follow the Bitcoin craze. On the right, you just have a couple of graphs. That bottom one is MJ. It's a weed ETF, which it's named MJ because I think weed is also called Mary Jane. So very intuitive on their part to get that ticker. You can bump to the next slide. So here is pretty much the performance since the start of the year. I think the last meeting was right around that election day. So we've seen pretty much just a slew of pharmaceutical companies let people know how effective their vaccine is. It ranges from 70% from AstraZeneca to 95% from, I think it was Moderna. So those have driven the market up in the last few weeks. Also notable, it was the best month in, I think, the entire year for the Russell 2000, which is comprised of more small cap, mid cap stocks. So the hope is that the vaccine will allow people to get out and start shopping again and bring more revenue to those small and mid cap stocks. Just another COVID update. So again, not a huge amount of time between our last meeting, but there's been a pretty big spike since then. I think pretty much it's right in the middle of that November through the end of the chart. So there's just been a pretty large spike, and we're likely to see another one due to Thanksgiving. That's actually projected to be 10 days from Thanksgiving. So I think next Sunday or Monday, there could be a pretty massive increase in cases. Deaths have followed the case trend upwards, but at a lower percent. And then, like we mentioned before, Moderna has told us how effective their vaccine is at 95%. They have applied for approval, and the earliest vaccines could start as around December 21st, which is pretty crazy, the amount of time they're able to get the vaccine out. And if that does go successfully, we might see a continued rebound in the Dow and some of the smaller Russell 2000 stocks. Any questions on the market update at all?
Has there been any change in the market due to the presidential election?
Yep. So I think we briefly touched on it a little bit last time, but the market really liked the fact that the Senate stayed Republican at this point. There's still a runoff in Georgia that will determine um, if there's a split in the Senate or if not. Um, so kind of what the market liked about that is the Senate won't allow as much of the policies and tax policies to get approved while still approving another round of stimulus, which there had been talks about that this week. Just, I think, more rumors than anything. But I think we've seen a pretty steady increase in the market since the election. Um, that supplemented with the vaccine news. And then I think in general, the market tends to do a touch better during Democratic presidential years. Um, so I think it's driven quite a bit off that. It's almost secured a year's worth of gains in just a couple of weeks. So that's something to note, but to also maybe be a little concerned about. Um, but there has been a general increase after the election was a majority decided. Any other questions on that segment? Okay, then we'll get into the topic of the week, which is investment analysis techniques. We have pretty much two we're going to focus on, which is fundamental analysis and technical analysis. Fundamental stems from measuring the intrinsic value by estimating all aspects of a business. We're trying to find what is the business truly worth and is there opportunity that the market isn't seeing there. Technical analysis, on the other hand, evaluates securities through statistical patterns in data, which we're going to talk about that one first, but it's more based on trends and graphs and whatnot, so we'll move on to that. So we're just going to go through a couple different types of technical analysis that are usually most common. The first being moving averages. So moving averages help identify current trends the stock is on based on averaging price action over a specific period of time. It removes small price variations. Say a stock shoots up and down in one day, it'll remove that variation. So the most common periods the averages are on are 200, 150 day averages, and they can act as support price or support, pretty much support lines for the stock prices themselves. And you can see that on the bottom right graph. It looks like the stock has kind of fallen back to, say, that's the 50-day moving average multiple times over the course of 12 months. So it can almost act as a support level. And mostly these moving averages try to help explain or use past performance to predict where the future price might go. Is there any question on the moving averages? And actually during COVID, there were brief points where the market fell to, I think it was the 100-day moving average, where there was a slight increase. Then obviously as the severity grew, it dropped to the 200-day moving average, and there was a slight rebound off the 200-day. But then ultimately it fell a lot farther just based on the unknown and the severeness of the virus.
I have a question.
Yeah.
So is this, I missed the very first part of it, but so would I, like, if I would go, let's say I wanted to buy, I don't know, Visa, and I went and I looked at these charts, am I using these charts as a guide to show the fluctuations? I'm reading the notes on the side. Is this why you're using these charts, or is this a chart about the market as a whole, or?
So I guess I would respond with how I would generally interpret it. That graph on the bottom right,
Okay.
we see it continually going back to that yellow line, which would be a simple moving average support. So if it hits that support number again, I think it would be a signal that, hey, it might be a good time to buy. Typically, it bounces off the support line. So if you were able to time it off, say that's the 200-day moving average, if it touches the 200-day moving average, you might think, okay, now I'm going to buy, because in the past, it's rebounded every time it goes back to the 200-day moving average.
Gotcha. So would you, on the top graph then, probably it's a little more volatile, is that what I'm understanding? So, but yet it's still on the up?
Yep, so definitely more volatile. The yellow one is obviously a shorter time period of moving average because it goes closer to the graph.
Okay.
So I think because the stock is so volatile, you'd want to look at a longer moving average, the darker one, and potentially say, where that second arrow is, that plus, I think those are months. So in the next couple months, you see a reversal in the longer moving average period. So that could be a signal. Okay, it's reversing on the 200-day moving average versus the 50-day moving average. It might be a good time to buy some of that stock now. Or on the flip side, you see that down arrow, the two moving averages crossing each other might be a signal that, okay, the long-term 200-day moving average is beginning to turn into a downward trend. So it might be a opportune time to sell. Does that make sense?
Yeah, it does. I would just be the type of investor that would go in the bottom one because it's more predictable,
Yeah.
I guess. I mean, I don't know, but
It's always easier to buy than to sell, especially
gotcha.
when emotions are involved. But I guess another way to phrase it would be the close moving average, the yellow one, is falling so much that it's affecting the long-term moving average, the
I
blue
see.
one. So if that trend were to continue, you'd continue to see the long-term moving average drop. I
Okay.
don't know if that made more sense or not.
This
But
might be a silly question, but did you add those little arrows? Like you pulled that and then you added those?
nope, so I pulled that from online.
Oh, okay. So they're pointing out the
They're
fluctuation.
pointing out where the two lines cross.
Gotcha.
So if the 50 and 200-day moving average cross in a bad way, it might be a sign to sell. Whereas if they cross, like in the second scenario, it might be a good time to buy.
Gotcha. Thank you.
Any other questions on the moving averages?
Yeah, so these are just readily available like online to view. You said that you didn't pull these for any
Yep,
kind
so
of stock.
these are just like examples to show the definitions.
Yeah.
But I think if you went onto Yahoo Finance, you could add moving averages onto there. So if you went to charts, you could add, I think all of the ones I'm going to talk about. It's just important to get the time frame correct. So you'd want to do it on a daily basis for most of these based on the moving averages. Just this one in particular, one of them I'm going to talk about will be an intraday, so within one day. But they are available, I think, on like Yahoo Finance. If you have a brokerage, like TD Ameritrade has them on their graphs. So you could probably get it through your brokerage as well.
Gotcha. And did you just learn about this like through preparing for this meeting, or have you actually used this for your investment strategies before? Or
Um, I use a messier version of it. uh, Pretty much, I use more of the following ones, but I think this one is better for support.
gotcha.
So like the second graph that keeps bouncing off the support, that's where typically I've seen more success, but I don't recommend any one strategy as a go-to.
See, this might be a digression, but you can like open an Ameritrade account really like for cheap. And then they give you access to all this stuff, and it'll parlay into a question I'm going to have at the end of the meeting, but it might be something you want to just like open a Scottrade or Ameritrade or something like that, just to have access to their research.
Gotcha.
I'm a big fan of TD Ameritrade as well.
You are or are not?
R.
Oh, I'm going to ask a question about that later on, but okay.
Okay, so the next one is RSI, which is a relative strength index. So pretty much it's a subgraph on the chart, which we don't have a picture here, but it's a subgraph that it oscillates between 0 and 100 based on the average price gains and losses over a period of time. So if there's a huge amount of average price gains, this value will go pretty much over 70. So that second bullet there, it can interpret if a stock is overbought or oversold. If it goes over 70, it indicates the stock might be overbought and is due for a decrease, or if it goes below 30, it could indicate it's oversold, and there might be a reversal. So there's the graph there. That yellow line again on the bottom, you can see the arrows at multiple points. It drops below, close to or below 30. And if you look at the graph above, it typically rebounds after it hits that point. And then you have the opposite scenario where it touches 70 towards January of 2014. And then, it's a reversal. So the indicator says it's overbought at that point, which is where you would sell. And then, so it's pretty much just oscillates between 30 and 70 to indicate whether it could be oversold or overbought. Does that make sense? And one note for that one is it's pretty hard to see it happening live and to act upon it. It's easy to look at this graph here and say, oh, it worked historically, but it is emotionally pretty difficult once it hits 70 to say, wow, it's been on such a good run, I don't want to sell. So that's some of the emotion, again, that hinders technical analysis. The third one out of 4 is the moving average convergence divergence, other known as MACD. This one is somewhat similar, and it oscillates between usually 2 and -2. This one is more of a momentum indicator. So when the lines cross, it indicates a change in momentum. So pretty much what happens is those two lines are over separate periods of time. One might be 50 days, one might be 100 days. So you can see at the end of the previous year, that first down arrow, they cross, signaling that there's going to be a trend reversal. So it's pretty much saying the momentum is changing based on pretty much volume. So as you can see, it does drop off quite significantly after that, and then there's another cross between the two, indicating that momentum is once again changing again, and there's a significant recovery. So the bar graphs as well show the distance between the lines. So if there's large bar graphs, you might be likely to see the trend continue for a longer period of time, and then as those bar graphs become smaller and smaller, the momentum might be starting to change, and it might be a sign to buy or sell. Does that make sense to people as well?
Yeah, generally how long after the or like how much of a lag is there in the predictor? Like if you look at the arrows, they're always after the trend starts to go back up. Like you get what I'm saying?
Yeah. I haven't used this much myself as a tool of investing. Based on that graph there, it looks like the actual convergence of the two lines is a little bit after the fact. So it might be when those bar graphs start shrinking, it might be that sign. But not having as much experience using this, that's a little tougher to answer. I don't know if anyone has any other experience in the group, but yeah, typically it looks to be just a little bit after the actual
In general,
convergence.
Coach, when you're looking at companies, you're not doing as much technical analysis as you are like company valuation, like what's like the value of the company comparatively speaking to what their stock price is.
Then Hugh will talk a little bit about the valuation later on. I typically look at valuation first and see whether there's value there. And then I'll take a look at some of the technical analysis and say, okay, if it's been on an absolute rip over the past month, it might be better to wait a little bit to get an entry point. So it's not, you should definitely use more than one method to evaluate trades. Any other questions on the MACD?
I have a question. So when they lines cross, there's a shift. Would it ever like cross to go in the same direction? So like, let's look at the second arrow from the left, and could it then cross there and be like, it's gonna drop, like have the slope would be substantially larger, or will it always go positive, negative, positive, negative?
And that positive negative doesn't have really an impact on the price per se. It's just the momentum of the stock. So because those two lines are different time periods, one might be a 30-day and one might be a 60-day, it's telling you that the influence of the 30-day falling on that first arrow then begins to drag down the 60-day, saying, okay, momentum is starting to shift negatively.
Gotcha.
Now might be a good time to sell. Or in the case of that first arrow, it looks like it might be a tad too late. But I think that second convergence going upwards looks to be at the start of the rally. So it really just comes down to your interpretation of the graph. But pretty much what happens is the smaller time period line influences the longer time period line, which indicates the change in momentum.
Okay.
Now, is this information that like is more likely to be used by, let's say, a day trader than like somebody like me who's just, let's just say, oh, I have $10,000 that I've earned over the course of the last 6 months. I want to invest that. I'm not going to like probably get too involved in statistical trends as much as I am maybe just going to like buy a few value stocks or maybe an ETF. Right? Like, I think it would be like from a white coat investor, it'd be silly of me to come try to go through a bunch of stocks and look at statistical trends and try to time the stock based off of, a few statistics.
Yeah, I would agree. I think it depends on the security. So more volatile companies probably won't work very well with this. They might work a little better on an intraday standpoint if they're very volatile, but maybe a company like Coca-Cola, they typically don't have much price variance, so it might be easier for this analysis over a long period of time for a company that's less volatile. But again, yeah, it does attempt to kind of time the market a little bit, which you always hear is never the correct strategy. So I agree with your points, and it's probably, I don't know who would use it more, small investors or very large investors with super large accounts. But it is interesting to follow. Any other questions with MACD? All right, we'll move on to the final one that I have. There's a ton more on Investopedia.com, so if you want to go, you can search for technical analysis or common technical analysis. There'll be tons of ones you can look at. So the VWAP is volume weighted average price. So it pretty much gives an average price of the security based on its volume. It can provide insight to both price and volume. This one is typically used intraday trading, so more of a day trading style. Most common time frames are 1, 5, and 15 minutes. And it's actually common, I don't know if it's common, but large investors and mutual funds use VWAP to move in and out of securities with as little impact to the share price as possible. So they'll pretty much try to buy below volume weighted average price and sell above volume weighted average price. And what that means is if there's a super high amount of volume, that'll factor into the price, the VWAP, and make the VWAP higher. If the VWAP is higher than that share price, then it would be a good time to buy below VWAP. So VWAP's indicating there's a large amount of volume, and the share price is trending upwards, but the share price is lower than VWAP, it would be a good time to buy. And the same vice versa for selling the share price above VWAP. It can also be used to reaffirm your trade. So say you buy shares of Coke at $50 and VWAP is at $60. It's pretty much indicating that based on volume and momentum, the share price will likely trend up to that $60 mark. So buying at $50 would be, it would validate your trade. I think do we have a graph for this one as well? I don't know if I did or not.
No, we do not.
Okay. It looks pretty similar to the previous ones. There's a subgraph which shows where VWAP is at. I think it actually can also be overlaid over the stock price, but it can pretty much be used intraday to tell if the share price is low based on volume or high based on volume. This one, I do a little bit more intraday trading just for fun. I probably use this one the most out of the 4 we've talked about. It's not always right, but from what I've seen, it typically tends to be right more times than not. But do we have any questions on VWAP? Okay, if there's no questions there, then we'll get into the fundamental analysis, and I'll kick it over to Hugh.
The fundamental analysis is kind of the other main strategy used in finance. What a lot of investors or educators would say is that fundamental analysis kind of conflicts with technical. Not that you can't use both, but a fundamental analysis would probably say like past price of stock can't predict future performance. That's one I heard a lot at State and at other jobs. So you're really trying to find the intrinsic value, which is like the true value of the investment. It would be based on dividends, cash flow, growth rate, and mainly looking at a single company. So that's like absolute valuation, is looking at what is one company worth. Is it under or overvalued? Then you have relative valuation, which is comparing similar companies, often called comps, and they use ratios to compare. So how do you compare Ford to GM. Those would be comps. And then you have quantitative is just information that can be shown in numbers. So both absolute and relative have quantitative factors, and then qualitative is just like relating to standards rather than quantity. So can't be put into a number format. This is the big strategy that kind of Warren Buffett uses. He's more of a buy and hold. So I just want to put this up there because I thought it's very interesting. Warren Buffett says you should avoid buying stocks because you think it's going to increase in price, because even the best investors are unable to predict how the market will perform. And his big thing is you're buying a business. So if you wouldn't buy a full business, why buy part of a business? You can go to the next one. So absolute valuation, I'm going to go through these somewhat quickly. If people are interested in these, we could probably do a meeting on like each one of these. They're pretty complex, but we'll just touch on them briefly. So I'll ask questions if you have them, but I might not stop like SCO was. So basically we're trying to find the true value. So there's sum of the parts, which basically is trying to take different segments of the business and assessing a value to each segment, and then coming up with a total value of the company. So many golf courses, a good example of this is many golf courses also have banquet centers. So what it'd be is saying, how much is the banquet center worth? How much is the golf course worth? Adding them together, here's what the total business is worth. You know, you can do that, and then you can adjust for, that would give you an enterprise value, which is like a full company including debt, and then you can adjust just for the equity holders. So by taking out debt, non-operating assets, etc. This one's pretty commonly used. It's pretty commonly used with a model I'll talk about in the next slide. The dividend discount model attempts to predict assets based on their present day. So it's basically saying that the dividends are indicative or kind of showing what the stock is valued at. So it's basically saying all future dividends discounted will give you what the stock is worth today. So a good stock to look at would be like oil stocks. Phillips 66 or Marathon, their stocks have been hit super hard lately, but their dividends have remained high. So in this model, you know, it would show that maybe they are undervalued. Again, there's a lot more to the model than just, you know, one valuation, but it does have some shortcomings, such as age and size of the company. If the company doesn't give out dividends, it's not used. So like a lot of tech companies, Microsoft, Apple has, you know, low or no dividends. A lot of, you know, there's different fields where it's more beneficial. And I think using this one would be knowing the advantages and disadvantages of the model. This one's kind of used, but not as much as the one on the next page. So discounted cash flow model is the most common valuation tool used by pretty much Wall Street, not necessarily your average investor because it takes a little bit more work, but it is something that, you know, an individual can use and can learn how to operate with. So basically it attempts to determine the net present value by taking all positive and negative cash flows and then discounting them back. So it'd take, you know, positive cash flows would be things like revenue coming in, taking out expenses. It takes out things like working capital. It adds things like depreciation, which is seen on financial statements but isn't a true cash outlay. If anything is over zero, so if an NPV is over zero, it's something that should be considered. That can also be coupled with maybe a hurdle rate. So a lot of businesses will say the hurdle rate will need to be 10% for us to invest in. Again, we can go into that more at another time, but hurdle rates also have their shortcomings of maybe you potentially give up on an investment because it doesn't meet one criteria, but it might have a lot of other benefits. There's two ways really to do this model. One is to calculate the enterprise value, and you would discount it using WACC. So this would show the value to both equity and debt holders. This one is, again, the same way you take out all of your positive and negative cash flows. However, you don't subtract debt payments, and you're just trying to find the total value of the company. There's also a way to do it where you get the equity value, and it's showing the value to only two equity holders. What the goal of this is, you take out all the cash flows, positive and negative, of a company, and then you also take out debt payments and interest payments to get to what would an equity holder get out of a company, and then you discount it back, often at the cost of equity, right? Any questions on this? I know there's a lot here.
Yeah, I have a question.
Yes.
Seems pretty complicated for just like an average investor. I mean, do you get this, like in my previous example, do you get this information on Ameritrade? I mean, you have to be kind of deliberate about knowing what to look for. So is this something that maybe you get better with over time, because then you know what data to use to get these values?
Yeah, I think I'll answer that in two separate ways. So the first is they do have this available on different websites. I don't know if Ameritrade, for example, has it. One disadvantage or something I'd caution when you are looking at that is it's probably coming from a sell-side analyst. Sell-side analyst's job is to sell. And if you're really good at making a model, you can make any company look great or terrible by changing, percentage rates. Kind of part of the model is you put in a growth rate. So if I want Aunt Ruth to buy, I could put in a growth rate of 7%. If I don't want Aunt Ruth to buy, I'll put in the growth rate of 2%, and it'll make a complete change. I think that a home user definitely could use these, even just for, your person that didn't study finance. There are models readily available online that are already like complete, and you would just have to fill in the data. And if not, I could always build like a simple one and send it to the group. Basically, it would be looking at, like, you could put in a couple things like net income, depreciation, a few factors that you could find on looking quickly on an income statement on, Yahoo Finance, Ameritrade, or whatever, and it could give you some sort of guide. So if the group wants, we could build like a simpler one that people could use.
I probably would need a lot of guidance in that.
Yeah, I feel like, me personally, like internal personal models are kind of outside the scope of what I would get myself into. I mean, I think there's a lot of good research out there. Like, to me, what's the most helpful is like looking at like ratios and like, on the Fidelity like research, like they have like a valuation team or screen that shows like a bunch of the valuation metrics and stuff like that, where modeling stuff like for the average investor, I think is too much work and can cause too much of like a risk of error in your own model that can make you make a wrong decision versus just looking at some of the key fundamental and research that's already out there and published. Now, if you're like day trading and in and out of, like, if that's like literally your job, then this all makes sense, but it's kind of my perspective anyways.
Yeah, totally. I think that,
and like another thing with cash flow models is like you got to have years of projected information, which companies are usually pretty reluctant to give like those kind of projections. and who knows how accurate those are, because nothing's audited, and it's kind of just whatever they tell you is kind of how they're building those cash flow models.
Yeah. Yeah.
But like that, but like when you think about like an analyst, like this is like a Wall Street analyst's job that's covering certain companies and stocks and industries. So like they're looking at, like, they get all that information, like the company gives them that information because they know that the analyst is either going to recommend or not recommend. And that's the whole purpose of like the investor relations group in these Fortune 500 companies, is to help the analysts come to like an accurate model and projection of what they think like a future price target is.
Yeah, definitely. Those are all good points. I think too, the biggest thing is know who's giving you information. If you're getting it from investor relations at a company, they will always make themselves look good. If you're getting it from a sell side analyst, they're going to do whatever their firm tells them to do. If their boss tells them we're going to sell this stock, they're going to show that it's not rising, or they're going to show that it's great if they decide to buy it. So just kind of have that as you look at other people's information, where it's coming from and what their agenda is. But definitely this is a little bit more complicated, but certainly not something out of the realm that someone could do. We can go to the next one. So then there's relative valuation. This is kind of what John was talking about more so, is looking at comparable companies and looking at ratios. So there's 5 different types of ratios. The first set is valuation ratios. It's kind of asking, is the asset at a compelling price? So one's like price to earnings ratio. Is the stock undervalued? Another is price to sales ratio. Price to earnings is interesting, and you can kind of even see macro trends in the economy as well as trends within specific stocks. So like for the S&P 500, for example, the median, I think is a better way to look at it, is price to earnings is like 14.8. The max was 123, and that was in 2009 when it crashed. And the min was 1917, which was 5.3. So like right now, the mean for a price to earnings is 37 for the S&P 500. So that might be, one way to tell maybe the whole market's overvalued, maybe not. It also lets you see within industries, within a set group of companies, what is the cheapest. It definitely is a good gauge and probably the most used ratio. Leverage ratios are the company's ability to pay long-term debt. So the most common one is debt to equity. So a higher ratio often shows that it's riskier, but you'll need to look at specific industries. So I know just from experience that oil in general is higher debt across all of oil. So it doesn't mean that it's bad if it's high. I think the key would be to look at companies in a comparable industry or in the same industry. Liquidity ratios shows the company's ability to pay debt and other liabilities. So you have the current ratio is commonly used. It shows if the company will be able to pay short-term debt with short-term assets. And then the quick ratio shows if the company will be able to pay short-term debt with just liquid assets. So it takes off stuff that's not super easy to sell, and it sticks more to cash and readily available funds. Any questions on any of these ratios?
Yeah, this is what I was getting at, is like what I think is the most helpful when like comparing companies. So you're like, oh, I like, oil and gas companies. Let me compare Exxon with, Phillips 66, with BP, with whoever. And a lot of the trading websites have all these ratios calculated off of like their publicly filed reports. So like their quarterly reports or annual reports. So that like they're accurate. And then it's easy to see, who's cheaper on a valuation perspective, who has more growth that might be more expensive, that, and if, you know, depending on what your risk appetite is, can help you make those decisions.
Totally.
So a good example of this might be if you were trying to identify a cruise liner to buy because of COVID, you'd want to look at their leverage and liquidity ratios to make sure, A, that they're not over levered with debt where they wouldn't be able to pay those short-term obligations, and B, whether or not they have the liquidity if they had negative cash flow for a long period of time to sustain those losses. So for example, if Carnival has a huge amount of debt and Norwegian Cruise Line doesn't at the start of the crisis, I would tend to view Norwegian as favorable.
Great example. Thanks, Scope. So then there's, Anna, you can go to the next one. There's performance ratios, which is really based off the company's profit. So you have return on equity, return on assets, return on investment. Earnings per share is probably the most common ratio. It just shows how much the company is earning per share outstanding. And then other common ones within financial statements that can also be found on, Ameritrade or different platforms is gross margin, operating margin, net margin, basically seeing, is the company making money in total? Is the company operating efficiently? Are they, using their assets, their equity, efficiently? And really this is gauging how well the company is run and how well they're doing. Activity ratios are similar to that. They're gauging kind of how efficient the company is running, as well as how good they are at day-to-day operations. So this is like inventory turnovers, number of times the company has sold and replaced inventory in a period. Higher is better, but just because it's low, it might just be an industry norm. I think it's something like bourbon or another alcohol is like a year or two is their average inventory turn time because it takes so long to make. And then receivables, how good are they collecting receivables? There's a bunch of ratios. You guys can look up all of them. But these are like the most common, the ones I, think are useful, but certainly not the only ones out there. And if anyone has any good ones that I didn't mention, please let us know because I'll be happy to look into more of them.
I guess just another quick note for those that, again, Investopedia is really good for those ratios. They have little 1-minute videos that help explain it very well. So I would definitely recommend Investopedia. If you search some of these, it'll be very helpful.
And then the last part is just quantitative information is basically what we've just talked about. Really would suggest going through financial statements. Even if you're not, a finance person or accountant, kind of just cruising through, especially something like an income statement, just lets you see how things are going. Generally, people that are in the business world understand them. And it just gives you a picture of what the company's doing. Qualitative are really things that shouldn't be forgotten about. It's something that can't be measured in a number, but they're important. So I picked 4 of the most common things to look for. So business model, what does the company do? Competitive advantage, what is it and can they keep it? Management, is it the right team for the right task at the right time? And then corporate governance, is it run ethically, fairly, transparently, and efficiently? Again, no one can tell you really. That's just based on you doing your own research into people. And these factors, are as important and sometimes could be more important than even the numbers. Any questions on that?
I don't have a question, but I like that. I mean, it's kind of important when you're buying a stock those types of questions you need to ask about it.
We can move on.
Okay. Okay, and now we're gonna move on to our next segment. We're starting to do, moving forward, this kind of stock show and tell as suggested by one of our members. Basically, the overview is that you're gonna pick one stock. We'll send you a template as shown on the right. This is an example. And basically, you're just gonna present to the group what your stock is, as well as provide all that information you see on the right. We're thinking about just taking volunteers at first, like, hey, I'll volunteer to do this month, whatever. Thinking 2 people per month. And after you present, we're going to take the stock or the company that you present and track it and follow it. And then in the following months, we will, just like those graphs we saw earlier, we'll give you, like, give everyone an update. Hey, remember when George presented this, here's how it's doing, and give all the details. And then finally, we're thinking that because there's so many different variables, if you have like something you really want to share, like, hey guys, this just happened, there's a new pandemic, you might want to sell your stuff or buy now or X, Y, and Z, you can make a video and we'll post it and then go back, post it on YouTube just to our little our group, and then go back and we'll talk about it, since we are doing these meetings monthly. So if you have anything that's urgent and is information that needs to get out in a few days, you can let us know and we'll get that information out to everyone. And so our first stock show and tell, George is going to give us a little presentation of his stock that he picked. And this will kind of be how we'll run through these moving forward.
Okay, and I will take care of the screen right now. Okay, so this is the first presentation. The stock I'm presenting is AMD, or Advanced Micro Devices, which was an absolutely stellar buy about 1 week ago. Since then, it's run up about 10 to 12%. I think it was in the range of 82 last week. It's already up to 92 as of yesterday's close. Quick background information: it's in the technology sector in the semiconductor industry. It carries a market cap of 110 billion versus the sector average of 90 billion. But there's a pretty wide variety. It's not very equal weighted. There's a huge discrepancy between the bottom and the top. So I guess the median might be a better way to gauge that. Company description: they're a semiconductor based in California that develops processors for businesses and consumer markets. Well, they initially made their own processors. They outsourced its manufacturing, also known as going fabless. This was after they spun off Global Foundries in 2009. Again, their main product includes microprocessors, motherboard chipsets, embedded processors for servers, gaming, consumer-related laptops. So I'm going to get into my analysis here. It's all qualitative. Quantitatively, it's a very tough investment to look at just based on how they're valued relative to their competitors. We'll get to that in a little bit. So they compete in, their major market is x86 CPU production. And there's only one other competitor in that space, which is Intel, a company much more people are familiar with. And the major case for AMD is in 2014, they got a new CEO and president, Lisa Su. They increased their competitive advantage by partnering with TSMC, a Taiwanese fab company. So when they went fabless, they began partnerships with other foundries, and now their largest partner is TSMC. Pretty much in semiconductors and chips, the amount of processing you can do in a amount of space is gauged by nanometers. So currently, the most competitive market is 7 nanometer chips. Apple or AMD released new 7 nanometer chips this year, and they've pretty much, with the help of TSMC, released these 7 nanometer chips. Well, Intel has been stuck on 10 nanometer for probably 3 or 4 years, and it just came out that they're delaying their 7 nanometer until 2022. So pretty much in a smaller package, AMD can produce more computing power, and that is shown on the graph in the upper right up here. So these are consumer chips that people can just straight up buy. AMD on the very top shows the amount of processing power for that single chip at $4,500. Intel's most competitive chip is a server chip, actually, which I don't think is available to consumers. It costs almost double of it and only has half the performance. So Intel being stuck on 10 nanometer has really hurt them, and the case going forward is that over the next couple of years, AMD will continue to take x86 market share from Intel, leading to huge gains in net revenue. And pretty much unless Intel goes fabless, there's no answer Intel can have unless they essentially go fabless. A couple major risks in that a lot of AMD's competitive advantage lies within TSMC, their partner, their fab partner. If TSMC were to get overwhelmed with orders, it could take away from AMD's share of product. So that is a very large risk. And then the other large risk is their current valuation, which we'll touch on that right now, actually. So their price to earnings ratio is 97.97 as of third quarter ending. The comps are 34.32. So they're pretty much valued 3 times the amount of other companies based on earnings, which, as an investor, like Huey said, Warren Buffett, you're pretty much buying. I guess that might be a bad example, but if you were to solely base this on price to earnings ratio, it would be a pretty bad investment. Price to sales, again, valued at almost 4 times price to sales to comps, but the return on equity has been absolutely crazy, 21.4% compared to the competitors' 4.16%. And then the current ratio, which we previously mentioned, is right in line with competitors. I think the real picture here is the qualitative measures. And then going into more, I was talking about the market share. So this is x86 market share, and these are pretty good estimates based on only having 2 competitors, and you can compare those competitors' sales directly. So in 2016, when AMD released their Ryzen architecture, after it was like Lisa Su's first main project as CEO, they had 17.8% market share. It turned out to be a huge success. They took 4% market share. Then even up to year to date through the third quarter, they're almost at 40% market share, which is absolutely insane. This includes laptops, consumer products. They were able to take 20% market share away from Intel in just 4 years, and Intel doesn't have an answer likely until end of 2022. That's partially why they're valued so high based to earnings. If we were to look at forward price to earnings, which estimates 5 years of earnings, it would come down to about 40, or I think still the competitors is around 20 or so, so it'd still be overvalued. But like I said, here's a graph. 2016, it was $2.28 a share, and then you can see its performance relative to that since they've gained that competitive advantage. Again, they're a $110 billion company. Intel, they're major and only competitor is, I think, $220 billion, so they're worth about half as much. But I think the major change could be that they continue to take market share throughout 2020, 2021, and most of 2022. So I guess that was just a quicker one that I've prepared. Do people have questions on that?
So what's the
Yeah.
recommendation, Judge?
Yeah.
Well, the recommendation last week was a buy. Based on some information I've gathered from Steve, it seems like the future price target is anywhere from $100 to $120 through the end of 2021. So definitely a lot less opportunity than what we're seeing here. Long term, I'd recommend it as a buy, especially if there's any short term dips in price. Another thing, they have a merger with XLNX, which is a different chip company that specializes in something other than x86. It's a pretty risky merger, but it would add billions of dollars to AMD's net revenue. So it would be pretty huge if that merger goes smoothly. And actually, if you look right here, that's where the dip came in, is when they announced that. It fell it fell a little bit just due to the risk of the acquisition, but I'd say long term, I'm keeping this until 2022 probably, and then I'll reevaluate based on the performance. Again, it's just a little tough because the last couple days it's run up about 10%.
Why is like NVIDIA not a competitor? Is it just because NVIDIA is more?
So NVIDIA is a competitor. The other major business segment of AMD is graphics cards, which is directly
That's
competitive
like what
with,
NVIDIA dominates, right?
yes, they absolutely dominate the graphics market, which it's a smaller portion of AMD's business, but recently they released their new architecture, which their new graphics cards are on the 7 nanometer as well. And if you search a YouTube video, AMD versus NVIDIA graphics processors, NVIDIA just had a huge cut into their competitive advantage because pretty much NVIDIA went with Samsung's foundry at 8 nanometers, and AMD went with TSMC's for their graphics cards at 7 nanometers. And it's essentially leveled the playing field performance-wise and price-wise. So I expect AMD to take graphics card market share as well. It's just a smaller picture than the x86 market.
And the x86 market is like more so for like personal computers, you said,
So
and like servers.
yep, pretty much almost everything you use runs off x86, all laptops, all desktops. Some servers don't, but a lot of servers do. But pretty much every laptop or every computer you've probably touched in your life has come with an x86 processor. It is also important. Go ahead.
I'll say one thing that like I think would be an interesting theme for like you or Huey to dig into and us to talk about is like all the buzz the past year or two is like cloud, like everything's cloud this, cloud, the cloud stocks are on fire, like CrowdStrike, Zscaler, like all those traditional cloud stocks. And now like it sounds like one of the next kind of on the horizon topics is what they're calling edge computing, which would a lot of these AMD and NVIDIA would fall into it as a piece of that pie. But it's basically like the shift from all of the data processing and data gathering happening on a computer and in the cloud, shifting out of the cloud to like everyone's personal devices because the computing power is getting you know, to this point, you can pack so much computing power into your phone that like to send the stuff from your phone to the cloud back to your phone is going to be obsolete. It's going to shift towards like everything's just going to be on your phone, and all your devices are going to like interact with each other and use each other to like you know, use that computing power versus like going back and forth to the cloud. So it's kind of like a newer area where I think a lot of the cloud companies and chip companies are probably like dabbling in, but I don't really know enough about it either. I just know it's like a hot topic, so it'd be interesting to talk about, I think.
Yeah, and that's a major new sector and hot topic, and I think that presents a little bit of advantage to Apple as well, because Apple actually just transitioned away from x86 processors to ARM processors for all of their MacBooks, which NVIDIA is trying to buy ARM. So there's this whole complicated merger and acquisition portion to it too, to see, you know, whoever's successful in their M&A could have a very good standing in the future. But yeah, I'd agree that the direct to device, like you said, is probably going to eventually be a huge market, and you know, I expect that a lot of these chip companies know that right now, and they're working towards that. So it'll be interesting to keep an eye on. Does anyone have any other questions on the analysis there? Again, I do want to stress there is a fair bit of risk in that they have a lot of money going towards a merger. They're already a very high valuation. Most of their success comes from another fab's success. So there is some risk, but it seems like the partnership between the two is very strong. So
I just want to add something to the group. So kind of how George mentioned in the last week, they jumped 10% for stuff like this. That's where Anna kind of mentioned doing like videos or sending out an email to everybody with one of these filled out, like, hey, this is happening in 2 weeks, or, you know, before we meet again, to let people get a head start. I just know that was helpful. George and I often text or call each other about stuff we know is coming before it actually happens. So we want everyone to kind of, if whoever has ideas or knows, you know, about something they're interested in, can share that with the group before it actually happens, and then everyone can kind of catch the upside if they want, you know, or make their own decision. So
Okay, well, that leads us into our discussion that we've kind of already been doing. Does anyone have any other information they want to add? What strategies have worked for them? I know Herzler, you said you do a lot of the ratios. That's helpful. Anything anyone has to add basically right here?
Yeah, like I said, I think for me anyways, like I'm not gonna have enough time to do the modeling and do some in-depth, you know, competitive advantage analysis. It's like it's more of what do I read? So like interesting articles, stuff friends send me, like hearing people talk on CNBC about like so-and-so's recent earnings report. And then, you know, if you listen to some of the earnings calls, I think that's a good source of information. So it's more of like that, and then forming like, okay, if everyone's talking about like these chip stocks, I look at my portfolio, I don't have any chip stocks. So like, do I want to buy NVIDIA? Do I want to buy AMD? Do I want to buy Intel? I have no idea, because I'm not going to do the technical analysis. So it's kind of like, to me, it's more of like reading research and reading articles and getting some perspectives and maybe bouncing ideas off people who I know are paid to make those decisions. And then like, if it comes to it, then I would just do like, you know, the compare companies feature in like Fidelity, and just like scan through like some of the key kind of relative valuation and relative comparable ratios and say like, all right, like if the industry is so focused on growth, who has the best growth at like a reasonable valuation, and just kind of like high level stuff like that. And then it's more of like, you know, what fits in my portfolio, and where I want like my risk to be, not as much of like an individual like analysis on a stock. But that's, like I said, that's more of like a time constraint. Like I like managing my stuff and like following these companies and following stuff on CNBC, but I'm not going to have the time to like do the dirty work of like research.
I think that makes a lot of sense, and I think another thing to leverage is your interests or hobbies. You know, I first found about the chip stocks because, you know, I build computers for Tropical Smoothie and a couple other businesses, and that's how I figured that out back in 2016. So, you know, if you do have an experience or information that you can leverage for a stock, I think it's important to share that as well. For example, if you go to like
Yeah, totally.
Tropical Smoothie and they're becoming public, then you know, we've got a good insight there.
Sounds like Steve knows when that's going to happen before I'll know that.
Alrighty, well, speaking of Steve, we will do if anyone has any other questions now or comments they would like to make, now is the time.
Just a fun note, Michigan State leads by 11 with about 6 minutes to go over Duke, so.
Let's go. All right, finally, next month, we are going to have our very own Stephen Kretz here speaking. So if you are watching this video, if you're watching this on YouTube, you're going to want to tune in for January's meeting. He will be talking about private equity, and I think a big chunk of the meeting will just be questions directed towards him because I know he has a lot of useful information. And finally, George and Huey put together this index that we'll be posting. George or Huey, if you want to give just a quick overview of that.
I think this was all Hugh.
Huey, you're muted.
Super high level. You can just flip through them as I talk. And if anyone's interested in any of the models, this is additional information to getting a better predictor, and just more information about the models. Again, like George mentioned, Investopedia. There's a lot of good, I think one's called Wall Street Finance. There's a lot of good online resources, and I'm always available to help if people want to ask questions.
When will we get the, I guess you called it the stock, what George did for AMD? I don't know what you called that.
The show and tell segment.
Yeah.
So we're going to do volunteers. So if you would like to volunteer to be January's, you may reach out to us. Basically what we'll do is just send you a template and you just do a little bit of research on basically your favorite stock or a stock that you think is worth sharing about. And then we'll send it out to you. You fill it out, send it back, and we'll put it in the slide deck, and then you'll present it in that month.
Okay.
We're also thinking about doing a quick video on how I put mine together, some of the resources I used. So we might post that on YouTube as well, just a quick 10-minute. This is where you can go for information.
Cool.
All right.
No one has anything else, and I think you're free to end this meeting. George, you can stop recording. We will post this on